Dave Gardner here at New American Funding. Hey, I'm doing this video today to dispel the myths that surround the whole need for a 20% down payment. Now again, it's ideal if you have that 20% down payment, but in today's world, the vast majority of my clients struggle on how to get over that down payment hurdle. So I thought I'd put together this video. We can talk about the different programs that are available to help you bridge that hurdle or jump that hurdle to get into a home. So I'm going to start out with a little whiteboard action here. So we'll start here. So one of my very favorite programs is a VA program. It is how I got my first house. It's an amazing program, and it's great for those that have served our country. A couple highlights to the VA program. It is a true zero down program. However, they have what they call their funding fee. Now this is important. Anytime you're going to try to purchase a home with less than 20% down, there's going to be a form of mortgage insurance. It's called different things by different programs. So in the case of the VA, they consider that, or they call that, their funding fee. Now the first time you use your benefit as a veteran, they're going to add 2.15% onto your loan amount to cover their mortgage insurance, in essence, to make sure that the VA is always solid. So again, first time use, 2.15 of your loan amount is going to be added on to the principal owed on your loan once you close. Now let's say you sell that home and you buy another one. Subsequent uses of your VA benefit are going to go to 3.3% as part of your purchase. They'll add that to your mortgage, again increasing the amount owed, but again you're walking in with nothing out of pocket. So then you're just covering closing costs. So in this particular example, using a $400,000 purchase, you're looking at a loan plus $8,600 on a first-time use, or $13,200 for subsequent uses of your benefit. Great program. It's really cool for our veterans to have this benefit available. Now, one thing here I'll throw in, if you're a veteran that has a disability based on VA standards, these two fees, or the funding fees, get waived. So again, great program to help you bridge that gap of getting into a home with nothing down. Next program down on my list would be the USDA Zero Down. They have what they call their guarantee fee. So again, we're looking at this. You're going to have a loan. So their guarantee fee is 1% of your loan amount. And then they have what they call their annual fee, which is basically a factor of 0.35 of your loan amount. And then they divide that over the 12 months. So in this example, your loan amount basically again on $400,000 plus $4,000 in their fee. And then a monthly a fee amount of $117. Now, the USDA is a great program. A couple downsides to that program is it definitely limits your ability to buy by really focusing on the debt-to-income ratios. And then location. The USDA has specific areas where you can use their program. Basically, consider it like this. Outlying areas are USDA qualified for the most part. So anything up and down I-5 from Marysville south, not typically USDA, but they have their map. You can go in and check properties on the USDA map to see if it's USDA eligible. The next one down, again, is the FHA program with down payment assistance. Now the state has a program where they actually will marry with the federal program. You take a little education course. And with that, you get into an FHA loan, and the state will, in essence, loan you the down payment money that sits in a second position until the day you refinance or sell, or get to the 30-year window where then you start making payments on that loan amount from the state. The state dictates the interest rate, but it's a great, again, hurdle jumper to help you buy a home if you have limited to zero down for that purchase. So here's what we're looking at. FHA program has their fee is 1.75 of your loan amount gets added onto your loan. It's upfront mortgage insurance based on the FHA. 1.75 of that gets added onto your mortgage, and again sits there as on top of your standard loan. 1.75 is their upfront mortgage insurance. And they have a factor of 0.85 each month. So again, using the $400,000 purchase price, you get a loan, plus we're going to add $7,000 to the principal owed on your loan. And then you're going to have a monthly mortgage insurance factor of 0.85, which is $272 a month. So again, the FHA program married to a state program, which allows us to bridge that down payment issue. Standard FHA, I'll talk about programs that have limited down payment. So standard FHA is going to be 3.5% down. You're still going to have the upfront mortgage insurance. You're still going to have the monthly mortgage insurance, but it increases your ability to buy with a couple other variables. And you don't have that money that's owed to the state. So standard FHA, 3.5% down, same numbers are going to apply. On a conventional, we have a conventional 3% down program. Now, this is a great program for first-time buyers that haven't owned a home in the last 3 years. 3% down conventional, which is a great program. Again, you're going in with your down payment of $12,000 down. Depending on where your credit is, this is where it's crucial to really focus on your credit, credit score, credit worthiness. Your MI factor could be anywhere from $132 impact a month to a $500 a month impact. So again, when we look at these different programs, we look at what makes sense. There's no broad brush for anybody. We take a look at where you're at, whether it's financially or credit score, down payment, availability for gift funds, things like that. We have some ways of bridging the down payment issue. It really comes down to each client. So how do we go from here? Well, again, we do that deep dive. Once we get into the process of an application, we really look at what makes the most sense. Dispelling the myth that you need to have a large down payment to make a purchase in the Puget Sound. You don't. Now, we have ways of bridging that, and so we look at each option and see what makes the most sense. Every program has a plus and minus. It really comes back to you and how that applies to your particular situation and what makes the most sense. So again, I just wanted to take some time today. I wanted to dispel this myth that you need to have 20% down. Given where we're at in our market in the Puget Sound region, we go from anywhere from 8 to 12% growth in inflation in property every year, year over year. So again, think about that. Can I save roughly 10% between now and the time I want to buy to get to that point where I've got 20% down? It's really tough, especially if you've got a family. So let me help you do an analysis, see what makes the most sense for you. Let's bridge that gap. I've been having this conversation for a lifetime. I've helped a lot of people get over that hurdle and help them figure out what works for them to get them into their first home. I'm available. Let's just talk. I hope this helps you. Feel free to share. Again, Dave Gardner, New American Funding. You do not have to have 20% down to make a purchase happen. Let's talk. Thanks. Bye.